Today, we're talking about how business owners who sell their company or have a major liquidity event can convert that cash flow into passive monthly income that funds their retirement indefinitely.
When a business owner sells a company or has a major liquidity event, what do they expect life and money to feel like on the other side?
I think most people don't think about it. They have their heads down, they're entrepreneurs, they're grinding for a long time, just trying to make that business work. Then all of a sudden they get traction, it's going well, and then boom, they have this major liquidity event that feels probably anticlimactic. And so not a lot of people give thought into their retirement and what that's going to look like post-sale of the company. So a lot of them don't have a plan for their money after they sell their company. And so I think it's about being thoughtful about what they're trying to accomplish now that they've had this major win. What do they want to accomplish now with that wealth? And getting smart about the design of their portfolio and how it's structured to accomplish additional goals post the sale of their company.
What are the usual surprises they experience once the dust settles?
I think a lot of them are bored, right? They are used to accomplishing things. They're ambitious. They're type A people. And then it all comes to an end and they don't have the same purpose as they had when they were driving the growth of their company. And so the post-retirement phase needs to be set up where they have new goals. They have new ambitions. Even if they don't need another dime, they still need to set up their investments to fund their family's lifestyle goals, their charity ambitions, future projects that are productive. Because I don't think type A people are meant to play golf every day. I don't think they're meant to go on beach vacations and lie around all year. Most humans do better when they're productive, and I think most entrepreneurs are better served if they have new ambitions and new projects post-retirement.
What do you think is the natural next step for most people post-sale? Are they going to an advisor? If so, what's that advisor prescribing to them?
It's a mixed bag. Some people love investments, are DIY investors, and want to set up their own portfolios and go deep on the weeds and due diligence on private funds. They want to analyze stocks. They want to make a new full-time job out of it because they enjoy it. But there's a giant subset of people that don't want to do any of that stuff. Their main profession was something completely different than investing, and they have no interest in the stock market or private investments. And so they end up outsourcing that. A large subset of people will hire an advisor, either a traditional one or one that deals with alternative investments, and they'll get their input on what goals are they looking to accomplish with this money. And then you can set up the portfolio to ideally fulfill those goals.
Okay, what are most of their portfolios looking like post-sale of their business or exit?
The majority of people, whether they go to a financial advisor or not, end up doing pretty vanilla strategies. Oftentimes it's a portfolio of ETFs that replicate the stock market's returns, and perhaps a bond portfolio to generate some lower yielding income. The problem with that is most entrepreneurs are not set up to then sell off that portfolio in pieces over time to fund their lifestyles. It's the equivalent of building this business and then selling off 4% of it each year to fund your expenses, your grocery bills, your vacations. Is kind of a foreign concept for entrepreneurs. They like the idea of growing the asset, growing the principal, never touching the principal, and then living off the income. And so that's a bit of a difficult thing for most entrepreneurs and business owners to wrap their heads around. Oftentimes they're better suited in an income growth strategy where they're leaving the principal alone and they're just growing the income from their portfolio, just like their business was generating distributions. They like when their portfolio generates distributions. And so that's why most of our clients prefer an evergreen income strategy where we're focusing on growing the income stream from their portfolio versus selling 4% every year, even if the stock market is down a lot and they would be selling a larger percentage of their portfolio. Most entrepreneurs just hate doing that.
Okay, so could you break down what that looks like? Why that would be more beneficial for someone post-exit?
It's actually pretty simple. We have two income engines. One is the foundation. That is an income stream from private investments, private income funds. Those are generating typically higher yielding monthly distributions than they would get from their bond portfolio, oftentimes a lot higher. And that sets a baseline of high income that they can take today. And then we set up engine 2, which is a portfolio of dividend growth stocks. It's a portfolio of some of the best business models ever created. And these companies are high cash flow generators. They distribute a lot of that cash flow through dividends, and they grow those dividends over time. And so that is the growth side of the portfolio. We leave those alone. We reinvest the dividends into that portfolio, which ends up just compounding more dividends for the future. So we set that aside for 10 years, and we focus on the income from today from private assets, and then we can stack those two on top of each other over time.
How do you vet these investments?
It's really more art than it is science. We go through our due diligence checklist. Oftentimes we're working working with institutional quality managers that have assets under management in the billions. So these are publicly audited. These are very high quality asset managers, most of which people cannot access on their own. Coming through a registered investment advisor like us can get them access to these higher quality managers.
For those listening that already have an advisor, could you see most advisors being able to implement a strategy like this?
It is difficult if they do not have experience in private markets. It's not impossible. They can do it, but it is going to take a lot of education, and they're not leveraging a 20-year track record of dealing in private markets. If you've been a general partner yourself and you've run private funds, it's just something that you're more comfortable with. You know what questions to ask. You know how to analyze track records. You are more equipped to assemble these funds together in a way that makes sense, and that adds diversification and strength to the income portfolio. And so it's not impossible, but I would not want to work with somebody that was learning on your dime. Ideally, somebody at that firm has had a lot of experience with private markets, and therefore you're benefiting from their expertise. So there's that, but the problem is typically not an education thing. It's more of a willingness. Do they actually want to offer these alternative strategies and these private market strategies? Because their business is pretty simple and it's highly profitable if they just keep their clients in ETFs and bonds. Because if you think about it, those are very liquid. Those don't require any special due diligence. It's a cookie cutter vanilla portfolio that they can apply to every single client and just rebalance every quarter or once a year. So there's not a lot of work to be done once you actually get those funds from the client into the company. It's mostly just maintenance and rebalancing. Most RIAs, most financial advisors don't want to offer custom portfolios, don't want to offer private income investments, alternative investments, because it adds a layer of complexity. It makes their business a little bit less predictable. It makes it less profitable. But the question mark is that good for the clients? Is that what the client wants? And the more wealth you have, the bigger your ambitions are, you tend to need these more complicated portfolios that can generate higher income streams, more diversification, and potentially higher returns than just a vanilla portfolio of stock and bonds.
Okay, so are there any cons of this strategy? You've given us lots of pros. Would you list any cons or things to be cautious of?
Of course, nothing is perfect. The trade-off to private markets and their potentially higher returns is illiquidity, right? You can't sell these things on a moment's notice. You are locking up your capital typically for a period of time, right? They can be 3 to 10 years, depending on the strategy of that particular asset class. And so that is a trade-off. Now, some investors benefit from that illiquidity because it encourages good behavior. Even if the stock market is down, they can't just fire sell their private assets on a whim. And I think most people know, they've seen the research, that it pays to stay invested. It's about how much time are you in the market, not about timing the market. And if you're 100% liquid and you can sell your entire stock portfolio on a moment's notice with a few clicks of the mouse, then you are more prone to overreact when you're in a 30% down market, which happens every once in a while. Every once in a great while, a 50% down market happens. And it's how you behave in those markets that ends up having a giant effect on your future net worth. Adding a big sleeve of private assets to your portfolio enables you to weather the storm, so to speak, because you're not seeing those crash as you are seeing your public market positions decline in a major sell-off. So yeah, illiquidity is a downside of private markets. Now, we try to offset that with adding the dividend growth portfolio, which is comprised of liquid, fully tradable securities that you can access on a moment's notice if something happens in your life where you need that cash flow near term.
For people that are interested, what does that first meeting look like when deciding if implementing the evergreen income strategy is right for them?
Yeah, most people focus on the number that they need to hit, net worth. As soon as we hit this X amount of net worth, then we can retire, then we can stop worrying about money. And we try to flip that. We want to focus on what is the amount of income that we want to set up and achieve on at least an ongoing basis. We don't want to just stop at that income. We want to grow past it. But what is the amount of income that hits our family's goals? And therefore, we can back into the type of income investments that we're going to set up and the amount of money that we're going to allocate to each strategy, layering in your liquidity needs to come up with the two engines needed to achieve that income goal in the future for you. And if you think about that, it's easier to pick a number, an income goal that you want for your family than it is a net worth, because you don't know what the stock market's going to do in any given year. And if you're just trying to pick, okay, we're going to sell 4% each year, regardless of whether the stock market's up or down, you actually don't know what your income's going to be in any given year, right? Because it's going to fluctuate with the stock market. Whereas if we say, hey, we want $300,000 of passive income coming from our portfolio each and every year, then we can set up the math and put you in the income investments to try to achieve achieve that. And ideally, that number is going to grow over time as these companies increase their dividend payments, as we compound your net worth even further through the evergreen income strategy.
For investors interested after listening, what are next steps? What does that look like moving forward?
Sure. There's resources below in the description, including a white paper, a link to the website. And if you're ready to book a call with our team, you can do that. Somebody's going to talk to you, figure out if this might be a good fit for your particular needs.